Hey there, and welcome. So, if you've ever changed jobs, you've probably had that moment where you're staring at an old 401k statement thinking, okay, now what do I do with this thing? It's a super common question, and today we are going to walk through the absolute smartest and safest way to handle it.
Yep, changing jobs is a big deal, and right in the middle of it, you've got this major financial decision to make. You've worked hard for that money, right? So figuring out how to move it without making a really costly mistake it's everything. Let's dig into the options so you can be sure you're picking the right one.
And let's be real, it totally feels like a dilemma. The paperwork can be super confusing, the different options all sound kind of the same, and the stakes feel incredibly high. I mean, one wrong turn and you could be looking at unexpected taxes and some pretty hefty penalties. But here is the good news. While there are a few different ways you can go, there is one path that really stands out. It's the one specifically designed to protect your retirement savings from those mistakes and just keep it on track, growing for your future.
And that clear, simple solution is the direct rollover. Honestly, just think of this as the VIP express lane for moving your retirement money safely from point A to point B.
So what exactly is a direct rollover? Well, the name says it all. It's a trustee-to-trustee transfer. The most important part, the part you really have to remember, is that the money is never paid directly to you. It goes straight from the institution holding your old 401k to the one holding your new account. Here's a way to think about it. You wouldn't want an armored truck to just drop a bag of your cash on the sidewalk for you to carry to another bank, right? Of course not. The direct rollover is that secure armored truck. It makes sure your money never leaves the safety of the financial system.
Now, to really understand just how safe the direct rollover is, it helps to look at the alternative, and that's called the indirect rollover. It sounds similar, but as you're about to see, it takes a risky detour that can get complicated and expensive really fast.
All right, let's break this down. Take a look at the left column, the direct rollover. Simple. Funds go from trustee to trustee. No surprise tax withholding, no stressful deadlines. It's clean. Now look at the right, the indirect rollover. See that first line? The funds go directly to you. And that one little difference is what triggers the two huge problems right below it, a mandatory 20% tax withholding and a very strict 60-day deadline. Okay, let's dive into that first big risk. When you choose an indirect rollover, your old plan is actually required by law to withhold 20% of your money for federal taxes before they even cut you the check. They don't ask, it's not an option, they just do it.
And just like that, poof, a fifth of your retirement savings is missing from the check you receive. That's a huge chunk of money to suddenly be without, and it creates an immediate, very stressful problem.
And here's why. The IRS gives you only 60 days, that's it, to deposit the entire original amount into a new retirement account. Not the 80% you actually got in the check, but 100% of it. The clock starts ticking the second you get those funds.
And that leads to the million-dollar question, doesn't it? You have to somehow come up with that missing 20% out of your own pocket to make the rollover complete. If you can't, that missing chunk is treated as a taxable distribution, and you could get hit with a 10% early withdrawal penalty on top of that. That's money that's not just gone today, you also lose all its future growth. It's a completely avoidable trap.
Okay, so now that we're crystal clear on why the direct rollover is the smart move, let's talk about the how. The great thing is, pulling one off is actually pretty simple if you just follow a few key steps.
Here's the game plan, just 4 steps. Step 1, decide where you want the money to go and get that new account opened first. Step 2, call your old plan administrator and specifically ask for a direct rollover. Step 3, and this is the most important part, confirm the check is made payable to the new institution for the benefit of you, not directly to you. And finally, step 4, just follow up to make sure everything arrived safe and sound.
This right here says it all. The payable to line on that check is absolutely everything. The second your name is on that line as the payee, the IRS sees it as a payout to you, and boom, you're suddenly in that risky indirect rollover mess we just talked about with the 20% withholding and the whole 60-day scramble.
All right, to wrap things up, let's just go over a few key rules and common mistakes. The whole point of a direct rollover is for it to be clean and simple, and avoiding these little unforced errors is how we make sure it stays that way.
So here's a quick final checklist. First, if you're of age for required minimum distributions, or RMDs, you have to take that out before you roll anything over. You can't roll an RMD. We've talked about the payee line on the check. I can't stress it enough. double-check it. Also, don't rush into choosing a new home for your money. Understand the fees and investment options first. And last, keep your tax bucket separate. Pre-tax money goes to a traditional IRA, and Roth money goes to a Roth IRA. Simple as that.
So when you boil it all down, the direct rollover is hands down your best bet. It preserves that awesome tax-deferred growth, it keeps your financial life simple and organized, and, most importantly, it protects you from those nasty, accidental, and very expensive tax penalties.
So we'll leave you with this final thought. Knowing the safe way to move your money is a huge first step. The next question to ask yourself is that old 401k from a job you left a few years ago really in the best place for you now? Maybe it's time to make that smart move.